You've likely heard the PepsiCo and Celsius Holdings news by now, but what does it mean for the broader energy drinks market? In my energy drink DSD Shakeup of 2022 content from about a month ago, I basically said, here we go again. So, let me first kind of give you a quick and dirty recap of the energy drinks direct store delivery distribution shakeup that happened 2 years prior because of the PepsiCo and Bang Energy deal. Essentially, hundreds of DSD partners across the country lost the opportunity to sell Bang Energy on its trucks with the company's transition to the PepsiCo distribution system. This was a massive blow to those DSD partners because up until that point, there hadn't been an energy drink company that stayed 100% independent and reached $1 billion dollars in annual revenue like Bang Energy did. Those DSD partners were being forced to replace Bang Energy with something similar, which, as you could imagine, was kind of originally thought to be no easy task. I predicted at the time that the biggest beneficiaries would be Celsius Holdings, C4 Energy, and Alani Nu. This is exactly what ended up happening, with each of those energy drink brands mentioned growing considerably and contributing to much of the growth dollars in the energy drinks category. That takes us to the second energy drink DSD shakeup. When I made that content at the end of June 2022, we already knew one of the two potential disruptive trigger events. The first happened on June 22nd of 2022, and this is when PepsiCo and Bang Energy announced they would end their 3-year exclusive distribution contract early because of poor performance. Though the flattish recent financial performance is happening at Bang Energy, it's still a $1 billion brand, and reverting back to its previous kind of independent, piecemealed national DSD strategy naturally changes the energy drinks business landscape. But for this to really cause some categorical disruption, it would require an expected but not necessarily guaranteed second trigger event. PepsiCo would need to seek another strategic partnership or a mergers and acquisitions transaction to fill its open energy drink slot within its distribution system. The target names I put on my shortlist in that last content were the same as those biggest beneficiaries from the original DSD shakeup of 2020 content. Celsius Holdings, C4 Energy, and or Alani Nu made the most sense for PepsiCo. Which one do you select though if you're Raymond LaGuarta, the chairman of the board and CEO of PepsiCo, or Kurt Tanner, CEO of PepsiCo Beverages North America? Let's be honest, the pressure is on, as both of these guys have been at their respective PepsiCo helms during some kind of mediocre decision making in terms of the energy drinks category. The refresh of the Mountain Dew G Fuel brand was quite honestly uninspired and needs another strategic shift, in my opinion. Mountain Dew Rise Energy kind of IP battle killed that go to market that had LeBron James attached to it. Rockstar Energy has gotten worse, even though the main purpose of that acquisition was to clear a path to optionality in the energy drinks category, and then the failed relationship with Bang Energy. PepsiCo leadership must get this decision right. And yesterday it made its move by announcing that the company entered into a long term agreement that makes PepsiCo the global distribution partner for Celsius Holdings. PepsiCo will also make a net cash investment of $550 million dollars. That's in exchange for 8.5% ownership of Celsius Holdings. Out of the three energy brands discussed earlier, this was the most impactful choice for PepsiCo because Celsius Holdings is about like 2 to 3 times bigger from a revenue perspective compared to C4 Energy or Alani Nu. This was also the most disruptive option for the energy drinks market because Celsius Holdings had 300 plus unique DSD partners. Most of these were added in the last 2 years and will create a deja vu moment for these independent DSD partners that will again be forced to replace another massive energy drink brand on their trucks. But before I talk about what will likely kind of happen across the energy drinks market and maybe which brands will benefit from this chaos, I kind of want to run down a bit of what I think the strategic rationale was behind the PepsiCo and Celsius Holdings deal. Firstly, PepsiCo couldn't risk falling behind in one of the fastest growing mature beverage categories. It cannot be understated enough just how important the energy category is and will continue to be within the beverage world. Secondly, PepsiCo will create two income streams from this deal. So they have a 5% interest income that will come on the convertible preferred stock, and then also a distribution fee from upselling wholesale finished goods inventory of Celsius. And then thirdly, Celsius Holdings gains immediate distribution scale and global reach that will accelerate its market share. That includes access to new consumption occasions through diversified channel exposure. Fourthly, Celsius Holdings gets much needed growth capital to fuel initiatives for its push towards $1 billion dollars in revenue. Overall, it increases optionality for Celsius Holdings that is extremely important during recessionary periods that we're likely heading into. And then, kind of finally, the preferred equity investment aligns long term interests of PepsiCo and Celsius Holdings, which was something that lacked in the Bang Energy deal. I'd argue the point of difference in these deals makes the Celsius Holdings one even more significant to the energy drinks market. The longer term nature of the PepsiCo and Celsius Holdings deal that includes preferred equity means this particular DSD shakeup could cause more permanent effects. This is because DSD partners are quite honestly pretty old school and they look to establish long relationships. I also think these DSD partners and other kind of energy drinks market stakeholders will recognize the difference in the Bang and Celsius deals from PepsiCo. These differences give them confidence in the staying power of the PepsiCo and Celsius Holdings deal. For one, while there's kind of nuance in these categorical definitions, Celsius Holdings being defined as healthy functional energy in the consumer's mind is more differentiated than the other PepsiCo energy drink offerings. Fact is that the Celsius consumer does not cross over much with Rockstar Energy or the Mountain Dew energy offerings. I can't definitively say the same thing about Bang Energy. That lessens cannibalization risks that were more pronounced with Bang Energy. Additionally, Celsius Holdings is not vertically integrated like Bang Energy is, so PepsiCo has more potential assimilation opportunities in the future. Finally, this is just the initial investment, and PepsiCo could expand ownership in the future based on KPIs and other trigger events. All that being said, change is really the only constant in life, especially when we're talking about the energy drinks category. So I almost guarantee more large mergers and acquisitions will happen that will inevitably cause further disruption to the category. So, what does the PepsiCo and Celsius Holdings deal mean to the broader energy drinks market? It will cause a game of DSD musical chairs to happen again. It's important to remember that in the short term, any distribution swaps, even upgrades, will cause some resistance to momentum of some of these growth brands. The changeover is always messy, regardless of how great the brand's team is and its execution is. That's true for any energy drink brand, from Celsius to Bang to C4 and Alani Nu. If the correct distribution changes are made, though, it's long term value accretive. So here's how I see the musical chairs kind of playing out. Bang Energy will have an easier time resecuring some of those original DSD partnerships. Yes, the legal woes will create some issues and force a sort of rebrand to happen so they can kind of get around that orange Bang judgment. But Bang Energy, like I kind of mentioned before, is still a $1 billion brand, and you don't get those kind of free agent opportunities very often in the market. C4 Energy and Alani Nu will get another major boost from their ability to secure new DSD partners or upgrade ones in some key markets. Additionally, kind of the next tier energy drink brands like G Fuel or Killcliff or LifeAid Beverage, and maybe even the newly launched energy drink from the supplement industry powerhouse Phorm, will get some benefit from the DSD shuffling. But arguably, the biggest indirect winner of the PepsiCo and Celsius Holdings deal is Ghost Energy. A lot of the DSD partners that Celsius Holdings will be forced to leave are AB InBev houses. AB InBev just so happens to be the joint venture partner on the Ghost Energy product. Ghost Energy has quickly become the fastest growing energy drink in the US market. With Celsius Holdings leaving those AB InBev DSD partners that were shared by both brands, even more attention and resources will be given to Ghost Energy. On top of that, Ghost Energy is the only energy drink brand that I mentioned that won't be swapping distributors and won't have the same risk to slowing its growth momentum. But I just kind of want to end on some quick final thoughts and repeat something that I always say in these energy drinks market videos. The category as a whole from energy drinks is really one of the most interesting and exciting CPG categories. And you just never know what's going to happen next. If you enjoyed this YouTube video, hit the like button to support me. Also, help me get to my short-term goal of 2,000 subscribers by hitting that subscribe button. I'd love to see you join me on this journey, but we need to fix the fact that slightly less than 70% of you that are watching this YouTube video right now are not subscribed to my channel, and that makes me extremely sad. But I do want to thank you for tuning in, and I'll see you in the next one.